Okay, this is the solution to Galloway, whatever it is. Maybe I don't know, I want to say Galloway Ford, but that's not it. And what they ask for in the first place is a horizontal analysis and then a vertical analysis. All right, and then it's going to go through two sets of ratios here. Now, the first thing is with the horizontal analysis, what you're doing is comparing one year to the next. Okay, that's what horizontal, just think about it, that it's going to go like this, one column to the next. And it could be the current year to an industry average, or to, it could be to another company, or it could be within itself, just looking at the prior year. And as we scan down these, you can see that they've all increased pretty much, except for long-term liabilities, those have gone down. But the way to calculate it is the question, okay? So what we're going to do is take the difference between these two. So 46.2 minus 42,000, that gives us 4,200, and then divide that by your base year. That's the key, okay, that this year right here is your base year. So it's the difference between these two divided by the base, and that's what gives us the horizontal analysis number. So for this first one, we've got, what is it, 4,200? So 4,200 divided by 42,000, 10%. Okay, so there's our 10% number. And notice how these are all expressed in percents because it's a percent of that total. Okay, or a percentage of the relationship between the two numbers. Now let's take a quick look at vertical analysis. Vertical analysis is different in that this mostly focuses on the income statement. Okay, and you can see here that that for the income statement, it's this is the prior year, that's the current year. Everything is expressed as a percentage of total sales. Okay, this is horizontal. So total sales, the reason why it's total sales is because that's the biggest number on the whole statement. So everything would be expressed as a percentage of that. Okay, so here's my 500,000 is 100%. Okay, I think it's the current year. It's got to be the 625. And then cost of goods sold then would be a percentage of the 625. So I'm going to take 520. 520 divided by 625. And I get 8.32. That doesn't sound good. Oh, right here. Yeah. This number. 80, so it's 83%. It's 0.832, so if you move the decimal over a couple, you get 83%. Okay? And then the next one would be 100,000 divided by 500,000. And I get 20%. I don't know. Oh, no, it's 105. I'm sorry. 105 divided by... I lost it already. 625? Yeah. 16.8 or 17%. Okay? So these are our expressions of the percent of sales, and this is a great number. This is a really good one to compare from one year to the next, and it's easier than looking at absolute values. You know, for example, if cost of goods sold was 83% this year, and last year it was 80%, okay, of sales, then you'd know that your costs were increasing. It would show you that. Okay, so this is really handy. Okay, so this isn't not rocket science. You just have to spend a few minutes and look at it and get it straight in your head. Okay, now let's look at these ratios a little bit. These are divided into two groups. We've got liquidity, and liquidity means cash. Okay, liquid refers to like liquid assets would be cash assets or accounts that could be turned into cash quickly. Okay, that's what that means. And then profitability, if you think profit, think net income. And for these three ratios, the numerator is always net income. Okay, so we'll look at those next. So for liquidity, we've got the working capital, which is an absolute value, and that's the difference between current assets minus current liabilities. It's, absolute value, really difficult number to use. You'd have to compare this to yourself only, in my view. You could look at other companies too, the ones that are really comparable. I mean, maybe your working capital is too high or maybe too low compared to your peers, but you'd have to be careful how you used it. And then the current ratio and quick ratio, and you know these. So the current ratio is current assets divided by current liabilities. Okay, both current. All right, now notice that because I'll get on the exam and people will have total assets in here, total liabilities. So that's 3.95. So I could take my total liabilities almost times 4 and get my current assets. So we're in real good shape here, okay? And then the quick ratio only includes cash, short-term investments, and net receivables divided by current liabilities. Sometimes this includes inventory too. I don't know if this is written right. I'm going to have to check it. Okay, so let's go on and I'll check this while I'm sitting here. Then the next one would be profitability. Okay, profitability ratios. And this is nice groups of ratios here. Liquidity and profitability are two key things to look for on a financial statement and evaluate. Okay, that goes a long way. So the first one is called return on sales. And when you see the words return on, think that that's net income. So net income divided by sales, 7%. And what does that mean? That means 7 cents of every dollar that we sell ends up in net income. Okay? The next one is return on total assets. And there's just one little tricky part here. So the return on is going to be net income, and they frequently add interest expense back here. And they do because if you're debt finance, that changes things, and it changes depending on the part of the debt and all that kind of stuff. So you'll see it both ways, but this problem is adding it back divided by average total assets. Okay, now average total assets are assets at the beginning of the year plus assets at the end of the year divided by 2. That's how we're doing it. Okay, if you were at work and this was a bank or some other normal institution, you would take the average of the daily total asset. You know what I mean? Or a minimum of 12 months and divide that by 12. You get a real average. That just the beginning and end of year is kind of faulty in some ways. Okay. All right, then the next one that's used a lot, this is a popular percentage here, is the return on equity. This is our residual interest. This is equity. Okay, so the return on equity is net income minus preferred. Okay, and I keep saying okay a lot, sorry. We deduct the preferred dividends because these dividends have to be paid first before any money is available to the shareholders. So we'll take net income minus preferred divided by average common stockholders' equity. And again, this is simply the beginning of the year minus the end of the year. No, beginning of the year plus the end of the year divided by 2. It's a very simple average. So we got 30% there. That's a good return. And then the last one here that is also profitability, but it's a little bit different than the others, is earnings per share. And to get the earnings, again, we take net income minus preferred dividends. It's considered like stock, okay? So net income minus preferred dividends, not all dividends, just preferred, divided by average number of the average common stock outstanding. Okay? So that's a lot of information, but it's just a recap of what we did. Now let's take a look at that quick ratio. So that would be 46.2, we've got cash, plus 69 accounts receivable, plus well, here they've got short-term investments. We don't have any of those, do we? No. So it's 115.2 divided by current liabilities. Okay, you gotta write that. 115.2 divided by current liabilities. And current liabilities are pretty quick also. They're just the 46.2. So 115.2 divided by 115.2 divided by 46.2. Oops. That gives us a terrible number. I hit the wrong button. 1152 divided by 46.2. I get 2.49. Yeah, and that's what it is. So in this case, they did not include inventory in here. Oh, I'll look at the problem and see if there's something special about it, but I think it should be there, but it's okay. Okay.